With events like the California wildfires and an increasing amount of hurricanes, investors might expect insurance companies to be posting record losses. However, when it comes to the share price, those big insurance stocks have been keeping up with both the S&P 500 and the TSX. Joining us now to discuss is Brandon Merkosky, VP for Portfolio Research at TD Asset Management. Brandon, welcome to the program, your first show, and a fascinating topic considering what we've seen in the headlines. Walk us through this performance despite the fact that we've seen a lot of natural disasters.
Yeah, thanks, Greg, for having me on the show. So, generally, when we're trying to understand what's going on with insurance companies, I first like to get into the mindset of the insurance customer. So, when are you most likely to buy insurance and not be as concerned about the insurance pricing? Well, it's when you're seeing these once-in-a-100-year events that keep happening over and over again, and as we see from the company's perspective, these events have been happening gradually over time, so they've been including it in their risk budgets and have well thought out. We also have a chart that I brought here today that shows the price return of these companies. So as we can see, the North American property and casualty insurance companies in light green there on the top do tend to have a little bit of a drawdown when these events start to happen. So like we can see there, the flood in Toronto, there was a little bit of a pullback. When the fires in Alberta were starting, there's a little bit of a pullback. The knee-jerk reaction is that these events are going to end up being worse than they usually end up being, and then as they play out, the stocks continue to compound.
All right, interesting stuff. I mean, we can see it right there on the chart. I almost forgot about the Toronto floods. I was actually out of town. My sons were sending me pictures of what it did to my backyard. So we're taking a look at these companies. We've seen the stock performance despite some of these big weather events. When we're looking to assess the quality of them, what are we looking for as investors? So
generally, what we're looking for is two things. So the first thing that you're looking for is an insurance company that can maintain a stable combined ratio through various economic environments below 100. So what is a combined ratio? A combined ratio is all of the loss claims that are coming into these insurance companies, plus the administrative and selling expenses, divided by the premiums that these companies are collecting. So a company that is running below 100 has a little bit extra left over for shareholders, and those above 100 aren't properly pricing their risks. The other thing that we're looking for is what's called prior period developments. So insurance companies, sometimes they don't always estimate the risks properly in the period when the claim comes in. And so if you're seeing lots of prior period development in the expense line, it means that the insurance company may not be properly pricing the risk on their policies. And then alternatively, companies that have positive prior period developments have taken a more cautious approach to pricing their risk and have a good handle of the risk that they're writing in their insurance policies.
Is that the biggest thing that people should be screening for as investors, the signals they need to be careful of, that part of it? Are there any ones they should be mindful of?
Yeah, so generally the other thing that you would look for is you would be screening for general profitability, so that would be reflected by return on equity. You could look at book value per share growth as well too, and the par, as I would say it, for these companies in the longer run has been 10% on the book value per share growth.
All right, so obviously when people think about these companies, they think about the natural disasters that we've seen. We've seen quite a few of them in the past year. We also have, of course, the threat of U.S. trade tariffs hanging over the Canadian economy. The clock is ticking on that again, despite the fact that we got a reprieve. Does that play out for the insurance companies at all?
Yeah, it does. And I really like to break it into two buckets. So the first bucket is the life insurance companies in Canada. These are companies like Sun Life, Manulife, Great-West Life. So with these companies, usually about 30 to 40% of their profit comes from, health benefits. So that's the dental benefits that you have with your employer or optometry. When you have an increasing tariffs, there's potential that this could be a headwind to employment in Canada. And if there's a headwind to employment and there's less people ultimately employed, then there's going to be less benefits being sold to companies. The other bucket is property and casualty insurers. They're relatively well insulated to the tariffs in the short term, but in the medium term, if tariffs result in inflation, that will mean that the price of the insured is going up. And what does that mean for these companies? It means that they get to charge higher premiums because the thing that they're insuring is larger.
Interesting stuff, and I hadn't thought about that angle too. If there's flow-throughs for an economy and the labor force, then the insurance part of the dental and the benefits. That's interesting stuff. When we take a look at this insurance sector, we talk about the profitability of these companies. How does it compare to other areas of the market?
Yeah. So I generally like to use return on equity as a good assessment of the profitability. The reason for this is because if you are taking larger risks, you do expect more volatility, and with more volatility, you're going to need more shareholders' equity to back those ultimate policies. If you're underwriting insurance policies that are more predictable, smaller losses, you're going to need less equity to ultimately back those policies. So you can see here we have a chart up of the return on equity of the North American property and casualty insurance companies, and really since 2022 they've been printing ROEs above the general financials industry, and they've actually been expanding since 2022 to a point now that they exceed the S&P 500. So why is this? So the first reason is interest rates have gone up, and insurance companies have a book of investments, fixed income investments, that as those fixed income investments come due and mature, the companies then get to reinvest these books into higher yields, which helps their overall profitability. The other reason for this is during COVID, it was very difficult to get an auto body shop to repair a car or to get a contractor to fix your house when an event was happening. This uncertainty scared away a lot of incremental competition from the industry, and then the stalwarts that remained had more pricing power than they've had in the last decade.
Interesting stuff. So obviously the insurance industry seems to be able to work through some of the challenges it has. Yeah. Is there anything we need to be mindful of, bigger picture about this industry, if someone's taking a look and doing their homework on it? Yeah,
so the key thing to look for right now is to see if there's potentially that incremental competition coming back into the industry that would push away some of the profitability that they've had on their underwriting. So a good way to do kind of like a check mark on this is to look at the policy volumes that they're writing. If we see step downs in the number of policies that they're writing, that could be an early indicator that more competition is coming into the market and that they might have to cede some of the pricing that they've been currently benefiting from. The other thing that we would look at as well too is what they're doing with their reserve accounts. So an insurance company, if they're running out of growth opportunities, may decide to return more money to shareholders, do reserve releases. And when they do that, that generally comes in the way of share buybacks or dividends. That may attract incremental, value and income investors to these stocks. But it could be also indicative of other things. So if an insurance company is reducing their reserves, it could mean also that they're planning on taking less risk go forward, which could ultimately result in lower return on equity. The other thing that they could be doing is they could be trying to improve their profitability metrics to attract incremental investors who are just screening by ROE. The potential implication of that is if you don't have enough equity backing the insurance policies that you're writing, you ultimately could be accepting more volatility as being an incremental investor today.